Bitcoin's violent market collapse is a deliberate, forced event. In a single 24-hour window, hundreds of billions of dollars were systematically erased from the total cryptocurrency market capitalization. Viewing this drop as a standard market correction means you're watching the wrong scoreboard. And in this market, missing the real signal is exactly how accounts get wiped out. Turn on any financial news network, and the explanation sounds perfectly logical. They claim everyday retail investors got spooked by economic headwinds and panicked, hitting the sell button en masse. Bright red banners flash across screens, and algorithms flood your feed with stories of average traders cashing out in total fear. Those headlines are a smokescreen designed to hide the true mechanical forces operating beneath the surface. Surviving the volatility of the crypto market requires looking past public panic and searching for the invisible, structural data recorded on the blockchain. When we examine the on-chain data, a glaring anomaly emerges that contradicts the narrative of a retail sell-off. This chart tracks wallet behavior against market value. While the price line drops sharply, the line representing small-amount Bitcoin wallets is steadily rising. Everyday investors bought the initial drop. The blockchain ledger records a widening gap between reported news and actual retail behavior. If millions of small-scale investors were buying the dip, a hidden, exponentially larger entity had to be dumping massive amounts of supply to force the price down. That overwhelming sell pressure comes directly from institutional algorithms executing forced liquidations. Whales multiply positions using a tiny, solid foundation of actual capital supporting a massive, precariously stacked column of borrowed shadow leverage. When a price dip shrinks that foundation, institutions most rapidly de-risk. This causes their borrowed positions to instantly shatter and vanish. The resulting crash involves zero human emotion. It is a cold, mechanical unwinding of institutional debt. Every leveraged position has an exact mathematical threshold. When the market hits that specific price, the first automated system dumps its holdings to pay back its loans. That initial algorithmic sell-off drops the price just enough to instantly trigger the liquidation point for the next institution's algorithm, forcing them to sell too. This high-frequency cascade bypasses everyday retail traders entirely, clearing billions of dollars in volume in a matter of seconds. Modern cryptocurrency crashes are instantaneous, machine-driven chain reactions operating at a speed and scale that humans cannot interrupt. Stepping back from the immediate panic reveals a very different picture for the long-term structural health of the market. This violent drop is a mandatory mechanical flush of unsustainable institutional leverage. Stripping away this shadow leverage removes extreme risk from the system, leaving behind a stable foundation for the next upward cycle. Understanding this mechanical reset allows you to move away from emotional reactions and align your strategy with the structural reality of the institutions themselves. Recognizing the buildup of institutional leverage and these algorithmic thresholds changes how you see the chart, turning a chaotic price drop into a visible sequence of events. Tracking these structural mechanics provides a clearer view of market health than the mainstream news cycle can offer. Subscribe to the channel to continue uncovering the mathematical truth behind hidden market charts. Click the video on your screen right now to learn the portfolio positioning strategies used to navigate the current aftermath.